today's episode. What are some of the best investment strategies for retirement planning in Kenya? And we're going to talk about bonds, money market funds, SACCOs, real estate, rates, and the business alternatives. This is a series, and in part one of this series, we broke down how retirement systems work in Kenya. We looked at NSSF, we looked at occupational pension schemes, we looked at individual pension plans, and how the entire retirement structure is structured. In part two, we did something even more different and more powerful. We calculated how much money you actually need for you to retire in Kenya. We saw that retirement is not a time thing. It's a number thing. It's not guesswork. It's mathematics, and it's about numbers. And at the end of the day, the numbers have to add up. And for many people, the number is in tens of millions of shillings. We looked at that in part two. And now the big question arises in part three. How do you actually build that portfolio? How do you actually build that amount of money? Because knowing that you need 20 million is a very different thing. But building it together, raising that particular amount, is a whole new different thing. Knowing that you need 36 million, the way we looked at, is a whole totally different thing from now having that particular amount of money. That's why now in this video, we are going to break down the best investment strategies for retirement in Kenya, including things like government bonds, money market funds, rental property, rates, and pension investments, as well as business ownership. And we'll not look into nitty-gritty things. We have done a video breaking down how to have a particular amount of money during your retirement. So this video, this is an overview of what you could actually do on a surface level, on a basic surface level. We shall not go breaking down how much this investment should give you for you to attain particular numbers, because that video we have already done it, and I'll most likely attach it for you to have a look at it. So before we talk about where to invest, we must talk about something that is very important, very crucial when it comes to investment. How do you choose the right investment vehicle? So we are going to look at 4 key factors to consider when or before choosing any investment. And it's important because anytime I talk about investment, I talk about investment as a game. Investment is a money game, and you want to stay in the game for as long as you possibly can, because the moment you lose money, then you are taken out of the game, and it's very hard for you to come back inside the game. Because at the end of the day, not every investment is right for every person. Bonds might be right for me, but it might not be right for another person. Money market funds, they can do well for person X, but they won't do well for person Y. Talk about business, it will do well for person A and won't do well for person B. So this is why we have to understand factors and factors that will enable us to succeed whenever we are investing in a particular vehicle. So factor number 1 is the risk level. And I always say that every investment has got a risk. Even the money that you save in a bank has got a risk. Money in a SACCO has got a risk, because people have lost money in SACCOs. Some are low risk, some are medium risk, and some are high risk. So what are some of the low risk investments? We are talking about, under low risk investments, we have got government bills and bonds. We have got government bonds, of course. Then we have got treasury bills. Then we have got money market funds. That they have got very low risk. These are stable and they are very predictable. Under high risk investments, we've got things like business ventures, starting a business and then growing it to levels where it's about to support you during your retirement period. Then you've got stocks, where you buy shares from a particular company. Then you've got real estate development, where you put up houses or commercial premises. Now, it's worth noting that risk is not bad, but you must always match the risk of a particular vehicle with your age, with your retirement timeline, as well as your financial stability. When talking about risk, it's worth for you to understand the following: that if you are 28, if you are in your 20s or even early 30s, you can take more calculated risk. But if you are in 50s and above, 50s, mid 50s, what is more important is capital preservation. It becomes paramount for you to preserve capital as compared to chasing high risk investments. So retirement investing is about balancing two things, that is growth and safety at the same time. As much as you want to grow, you have to be checking like, are your investments safe? So that's where risk comes in. Factor number two is time horizon. How long do you have before retirement? And in part two of this series, we broke down that most people will, you live for 10 years or 20 years or sometimes even 25 years after retirement. So the time that you live in retirement is a very key factor when it comes to understanding where you should invest your money. If just to make sense out of that point, if retirement is 25 years away, you can invest aggressively. You can decide to take risk. But if your retirement is 5 years away or 10 years away, you need investment vehicles that are more safe, those ones that will make sure that your capital is preserved. Time reduces risk. The longer the time, the more volatility you can tolerate. Factor number three is what we call liquidity. And we've talked about liquidity on this channel. It basically means how quickly can you get your money when you need it. And so we have got money market funds that are very liquid. Bonds are moderate liquid. Rental property, low liquidity, and businesses very low when it comes to liquidity. So when you are planning for retirement planning should include both the liquid assets, the likes of money market funds, and the long-term growth assets, the likes of businesses and rental property, because we always say that you have to mix both these two categories so that you are on the safer side. Then factor number four, which is the last one, is the return potential, and this is growth versus stability. Some investments will grow slowly but safely, while others will grow fast but very unpredictable. The goal is not always to chase highest returns when you're planning for retirement. The goal is to have sustainable long-term growth that will beat inflation. Remember, we've talked about inflation in part two, which ranges from around 6%, 6 to 7% on an annual basis. So anytime you're planning for retirement, the vehicles must always be able to give you a higher value, higher rate than 6 to 7% inflation. Now that we fully have a grasp, we've understood the decision framework where we shall be investing our money. Let's break down the major retirement investment options that people have in Kenya at the moment. I've considered the factor that we talked about. I've considered safety, time horizon, and the growth perspective aspect when investing. So these are the best investment strategies for retirement. Number one, government bonds and treasury bills. These are the low risk foundation. And we've said that risk is a factor that we should always consider when we're talking about investment. Government bonds in Kenya are considered to be low risk. Why? Because these are backed by the government. They are avenues, not avenues per se, but they are backed by the government. What do they provide? Bonds and bills provide three key things when it comes to investment. Number one, predictable interest income. Number two, fixed returns over time. And then number three, the last one, stability in your portfolio. Treasury bills are in three categories. And basically, treasury bills are short term, and then treasury bonds are long term. So treasury bills are in three categories. We've got the 91 days treasury bills, that is 3 months. Then you've got the 182 days, 6 months. Then you've got 364 days. Like their maturity period is either 91, 182, or 364 days. When it comes to treasury bonds, these are long term, 2 years plus, all the way up to 30 years. Now, when it comes to retirement, bonds are excellent for the following reasons. Number one, they're excellent for capital preservation. You have money, you have 3 million, 5 million, and you don't want to lose that money. That is capital preservation. Number two, why they are excellent: income generation. You want a vehicle that will constantly be giving you money. Then number three, reducing overall portfolio risk. So that we've talked about risk. So when you have bonds in your portfolio, they will reduce the risk because the government has never failed to pay, and the government will never fail to pay. Bonds will not make you rich instantly. Bonds will not make you rich overnight. But what they do is that they preserve your capital. They protect your wealth so that whatever the wealth that you've accrued over the working time, over the working period, that money is not lost. So they protect wealth. So as you approach retirement age, bonds become very important. We've done videos on how to invest in treasury bills and bonds. I will leave it in the description for you to have a look at. Vehicle number two is money market funds. And when we talk about money market funds, we're talking about stability and emergency layer, what we refer to as liquidity. What are money market funds? Money market funds are low risk, high liquid, and they're ideal for emergencies. Now, where do they invest their money? Money market funds, when you put your money in a money market fund, like Etika Money Market Fund, I use Etika Money Market Fund for my investments. I'll leave a link for you in the description if you want to check it out. It's free for you to sign up and for free for you to invest, so that anytime you have got some free money somewhere, you don't put that money in somewhere where it doesn't give you interest. Put it in a money market fund so that it can be giving you some more money, baby money, as I like to call it. So money market fund, when you give them money, they invest that money in either treasury bills or short-term instruments or bank deposits. It's paramount for you to understand the following: that money market funds are not high growth tools, they are stability tools. In retirement planning, money market fund will serve as a cash reserve. They reserve your cash, and they'll also serve as short-term income buffer to give you the liquidity aspect anytime you need money. Every retirement portfolio, when you're building a retirement portfolio, any retirement portfolio must have some liquidity aspect, so that when you need some money urgently, you don't have to go and take your money from other investment places. Vehicle number three is a common one to Kenya. It's a very common vehicle. Is SACCOs. SACCOs are good for investment when it comes to retirement. And when you talk about SACCOs, SACCOs make sense to Kenyans because Kenyans have embraced the SACCO narrative. SACCOs, you know what SACCOs means? Savings and credit cooperative organizations. And these are some of the most powerful yet underestimated retirement tools for Kenya at the moment. Why is it so? Because SACCOs offer two major advantages. Advantage number one, they give consistent dividend income. And then advantage number two, they give you access to affordable credit facility. When you consistently save in a SACCO, when you consistently contribute in a SACCO, number one, you earn annual dividends on shares, and they give 10%, 12%. There are SACCOs this year that have given even 15 or 16%. So you earn annual dividends on shares. Number two, you earn interest on deposit. And then number three, your savings grow steadily over time. And anytime you want a credit facility, you can always get it from a SACCO at a reducing balance. Some SACCOs in Kenya have historically been known to pay competitive returns compared to traditional savings account. I talk about 10%, 15%. And we've also done on a video on some of the best SACCOs to invest in. I'll have it attached in the description for you. So for retirement SACCOs, like when if you're considering SACCOs for your retirement, SACCOs can serve as a disciplined saving system, as a medium risk income generating asset because they pay you dividend, and then also as a leverage tool for acquiring rental property or business assets because of their facilities, credit facilities. But there are important things that you have to consider when you talk about SACCOs. All SACCOs are not equal. You must check the following factors when you're considering SACCOs. Factor number one, their financial statement. Factor number two, dividend history, factor number 3, governance structure, factor number 4, membership growth, and then factor number 5, loan default rates. Then an advice, avoid over borrowing. Many people join SACCOs mainly for loans or credit facility and not building wealth. It's important for you to, when you're joining a SACCO, start thinking 10 years, 20 years, 30 years from the time that you are joining, so that you think about building wealth and not just about getting credit facilities for immediate consumption. If SACCO, but now I can clarify, if SACCO loans are used to buy appreciating assets, talk about property or productive business, then that's a strategic move. But if you are using loans for consumption, this will weaken your retirement planning. A smart SACCO retirement strategy will look like this. You consistent monthly deposit, you're consistently depositing money, you are investing your dividends, then you use your loans for income generating assets, and then you build shares for long term. SACCOs can become very powerful and a very powerful second pillar after pension, especially for people who are salaried employees. But like every other investment, they must always be part of a diversified plan, not the only plan. Let it be part of the bigger portfolio that you are building. Let's look at vehicle number 3, rental property. Rental property is popular in Kenya. We've done videos on rental property. Why? Because it produces monthly cash flows and it gives you long-term appreciation. But real estate has got realities such as high capital requirement for you to start, vacancy risk, maintenance costs, liquidity challenges, and you are at the same time you have to pay tax for the property. But property works well for retirement if it's properly managed, if it's not over leveraged, and if it's located strategically at a place where you shall not be having vacancies. Rental income can always replace your salary income in retirement, but it must be structured carefully. Number 5 vehicle is REITs. REITs is real estate investment trusts. This is owning real estate without managing tenants. We've done videos on how to start investing in real estate. If you want to look at it, I'll have it attached here. And what basically happens is that you buy units, and these are professionally managed properties, and when they earn when they make profits, of course they'll always make profits, you earn dividends. It's like you're buying shares in a particular unit. So when the property and the business makes profit, you earn dividends. What are some of the advantages of REITs? Lower capital entry, diversification, and no tenant management stress. REITs combine real estate exposure as well as stock market structure. Who are they ideal for? REITs are ideal for people who want property income, but you don't want the headache or the management stress that comes with managing tenants, managing property. You have got leakage here, you have got roof leakage here. So it removes the headache or the headache from managing property. Then the last vehicle is business ownership. And we talk about business, we talk about high growth and high risk at the same time. Owning a business can be very powerful for retirement. I personally own one. There's a business that we started a couple of years ago, and businesses are very good. It's a single business can replace your entire retirement plan. But businesses are risky. Why? Because a business can they are not predictable unless you structure them well. What can a business do? A business can grow exponentially. A business can create wealth. A business can generate long-term passive income. At the same time, businesses can fail, businesses can collapse, or businesses can be disrupted. And I'm reminded about the COVID-19 period where thousands and thousands of businesses went under. Why? Because businesses can always be disrupted unless you structure them well. And one major mistake that people do when it comes to business is that they say that my business is my retirement plan, having in mind that businesses are unpredictable. So unless you put structures in place so that your business is able to stand a test of time, your business is able to stand times and seasons, then at that time it will be able to serve you. As I always say, retirement should not rely on one unstable asset. But business income should be diversified into pension, for example, bonds, property, and other investment. You get the profit from business, or you get the income from business, but still diversify it into other vehicles like bonds, pension, property, and other investment. Now that we've looked at some of the best investment vehicles where you can invest, it just makes sense for us to look at the ideal retirement portfolio mix. How do you come up with an investment portfolio that will be able to serve you in your retirement? I have to be frank with you here. There's no universal formula, but generally, I'll talk about people in different stages, so that if you are in this stage, what do you do? Now, stage one, younger professionals. If you are 10 years or below in your profession, invest more in growth assets. For example, invest more in businesses, invest more in equities, invest more in property, invest more in moderate bonds. And I do coaching on business, how to set up a business, especially if you're employed and you don't have time to research or put up a business. My team does that. Now, if you are in your mid careers, you've worked in your for 15 years, 15 to 20 years, you are looking at a balanced growth and stability. If you are near retirement, you are in your 50s, you are looking at higher bonds, you are looking at income producing assets, you are looking at lower risk exposure because you don't want to lose money. Because, as I've always said, investment is a game, and when you lose money, you are out of the game. So the strategy evolves around age. Retirement planning is very dynamic. So it's important that you factor in your age. What's the age that you are in versus what do you want? What are you looking for when it comes to that retirement? Now, I'm closing. I'm finishing. Now that you understand something critical, where to invest in, retirement wealth is not built by saving alone. It's built by choosing the right asset, managing the risk, balancing growth and stability, and finally diversifying your income streams. That marks the end of part 3. Now, in part 4, we will go deeper into personal pension plans, because not everyone is employed. What if you are not employed? What if you are a freelancer, or you are a social media manager? You're working for your own. You are a businessman. How do you choose the right one? How do you plan for your retirement? Because you not work until you are 70. There are times that you won't work and you'll want something to still be giving you income. So in part 4, we shall look at how tax benefits work and how to structure retirement even if you are self-employed. Because investment strategy without structure can fail and will fail. And structure without strategy can stagnate. So retirement is not luck, it's a design. It's something that you mold, it's a process that you structure well if you want it to serve you well. So that marks the end of part 3. I'll be seeing you in part 4, and I'm more excited about part 4 and part 5, where we shall be finishing this series. So thank you for watching, and I'll see you in the next video. Bye bye for now.